All right, let's dive right into this explainer. If you've ever fired up a price chart and just felt totally overwhelmed by a literal spaghetti mess of lines, clouds, and colors completely covering up your candlesticks, hey, you are definitely not alone. Today, we're bringing absolute clarity back to your screen. We're going to look at a genuinely brilliant tool that takes the massive power of traditional Japanese trading indicators and neatly packages it away from your price action so you can actually see what the market is doing.
Here's the game plan for today. We'll start with the cluttered chart problem, break down the anatomy of the oscillator, decode the trading signals, look at combining with other indicators, and wrap up with the ultimate risk strategy. Let's get into it.
Section 1. The cluttered chart problem.
Okay, before we get to the fix, we kind of need to understand what's actually broken with the traditional Ichimoku cloud. If we strip away all the jargon, as you can see mapped out here, it's really just a series of math-based moving averages acting as support, resistance, and momentum guides. You've got the fast 9-period conversion line, the slower 26-period baseline, and then leading spans A and B dragging all the way out to a 52-period calculation to build that famous cloud. They all act exactly like standard moving averages, evaluating momentum and projecting future zones.
But here's the massive headache. The traditional cloud sits directly on top of your price action. It's just pure visual noise. Yeah, the data's insanely powerful for sure, but having a lagging span bouncing around and thick green and red clouds painted right over your candles, it causes some serious visual overwhelm. You literally cannot see the price structure through all that chaos, and that leads to hesitation right when you need to be taking action.
Moving on to Section 2, Anatomy of the Oscillator.
So how does the oscillator actually fix this? Well, it beautifully distills all that chaos by taking the overlay data and stacking it neatly below your chart. It does this by measuring 4 specific distances. Step 1 is the distance between the cloud and the closing price. Step 2 measures the cloud to the lagging span. Step 3, the conversion line to the baseline. And Step 4 measures span A to span B. It takes those 4 exact distances and stacks them up into one clean, highly organized histogram.
Now, here's where it gets really cool. You can instantly, literally in a split second, gauge momentum just by looking at how these 4 layers behave. If they're spreading apart and expanding in the same direction, boom, strong momentum. But if they start to contract, flatten out, and overlap each other, that is a massive red flag for weakness, telling you we're probably entering a flat, choppy market or a pullback.
All right. Section 3. Decoding the trading signals.
Now that we know how it's built, let's decode the actual color-coded signals. It essentially does all the heavy lifting for you. The visual cues are super stark. Take a look at the left side. Green histogram bars popping up above the center line, wrapped in a green background, that absolutely screams uptrend. On the flip side, when that histogram dumps below the center line, turns red, and swims in a blue background, you're clearly in a downtrend. It takes less than a second to spot the broader market direction.
But how do we actually time our entries? The indicator uses these really simple icons. A multiply sign is your early warning. It means the previous trend is probably exhausted, but hold your horses. Don't jump the gun just yet. You always want to wait for that initial multiply sign to be confirmed by a triangle. You're looking for a white triangle to confirm a long position or a yellow triangle to confirm a short position. That triangle is your ultimate green light.
And there's this brilliant built-in safety net, the gray multiply sign. You'll spot this when the very first layer of the histogram crosses a 9-period exponential moving average against the current trend. It's essentially flagging a minor pullback or short-term weakness, giving you a highly tactical spot to take partial profits without having to abandon the entire trade.
It also hands you secondary entry points on a silver platter. During an established trend, when the conversion line and baseline cross again, you get a pullback entry signal. White multiply signs in an uptrend, buy the pullback. Yellow multiply signs in a downtrend, short it. Oh, and if you find those gray profit-ticking signs a bit too visually distracting for your personal setup, no worries. You can just completely disable them in the settings.
Which brings us to Section 4, Combining with Other Indicators. Time for a quick reality check, folks. Relying on one single tool is a fantastic way to blow up your trading account. The source material hits the nail on the head right here. False signals happen. You will get them, for sure, especially in flat markets or when the price just decides to randomly reverse. Blind reliance on any one tool, even one as gorgeously designed as the Ichimoku oscillator, is just plain dangerous. To actually be a successful trader, it is absolutely crucial that you combine this oscillator with the broader market context. First off, map out your major support and resistance levels. Think of these like concrete walls. If the oscillator flashes a buy right underneath the massive ceiling of resistance, yeah, you hit pause, because price is probably going to slam into that wall in reverse. Next, layer in your volume indicators. Volume is the fuel in the tank. You want to see rising volume confirming that buy or sell signal so you know the momentum is real. Basically, use the oscillator as your precise timing trigger, but rely on support, resistance, and volume to prove the trade actually makes sense structurally.
And finally, Section 5, the ultimate risk strategy.
Look, even with the absolute perfect confluence of technical tools, losing trades are just part of the game. Burn this into your brain right now. There is no indicator or strategy on planet Earth that gives you a 100% win rate. It simply does not exist. Actually accepting that you're going to take losses is the ultimate psychological hurdle you have to clear before we talk about this final rule. Because if you can't accept that, no magical indicator is going to save you.
And that brings us to the golden rule, the 1% rule. Risking only 1% of your account per trade is the ultimate survival tactic recommended by the pros. Why? Because it guarantees that when those inevitable false signals pop up, and they definitely will, your account doesn't get completely wrecked. Proper risk management gives you the staying power to just ride out the noise until the next massive trend lines up perfectly with your oscillator.
So I want to leave you with this to chew on. Are you actually trading the context, or are you just blindly following the signals? The Ichimoku oscillator is a phenomenal piece of software. It cleans up chart clutter and beautifully translates complex Japanese moving averages into super clean momentum bars. But it only unleashes its true power in the hands of a trader who gets the big picture. So use it to time your trades, absolutely. But always confirm with your wider technical analysis. Keep that in mind the next time you fire up your charts.